Okay, hi everyone. Welcome to Collateral Onboarding call number 9, held on October 7th, 2020 at 5 p.m. UTC. My name is Juan. I'm here with some 4 participants and counting. And we will have two of my favorite projects today in the collateral for collateral onboarding. One of them is Balancer. So we have Fernando Martinelli, and the other one is tBTC / Keep Network. So we'll have Matt Longo presenting. The format is, as always, 10 minutes. We're a little bit late, but let's try to keep it on schedule. A presentation and then 20 minutes for Q&A. So Fernando, if you're ready.
I'm ready, yeah, I'll be quick.
Great.
Hi guys, hi everyone. Thanks for inviting us, Juan. Thanks also Will and all the team members who did a great job at coming up with the proposals and all the data to substantiate the proposals. That was really cool. So very happy with that. Thanks a lot. Can you see my screen?
I can't, but maybe other people can.
I can.
Yeah, we can.
Okay.
It's good.
Awesome. Yeah. So Balancer is a protocol for programmable liquidity. I think we all are quite familiar with Uniswap, and I like to explain, like, the easy way to explain Balancer is it's a more generalized version of Uniswap, where anyone can create pools that are not limited to only 2 tokens and 50-50% weights. And many people don't realize that, but when they provide liquidity on Uniswap, they are obliged or forced to always put the same amount of value in both tokens that they in the pool that are in the pool that are providing liquidity with. Balancer allows you to think of a pool more as a portfolio management tool. So you can put the assets that you have, and Balancer will balance them for you. So if you start a pool with 30% DAI, 40% ETH, and 30% WBTC or tBTC, you can rely on Balancer to always keep that balanced for you. And instead of like conventional index funds where you have to pay the manager of the fund, you have to pay a fee like Fidelity or others. On Balancer, with Balancer, you actually get a fee, just like LPs get fees on Uniswap. Balancer pools also have trading fees. And we also have a flexible choice for trading fees. So you're not always forced to have a 0.3% trading fee like on Uniswap. You can choose 0.0001 or all the way up to 10%. So that's our idea is like to be fully flexible and to be a primitive for people to build on top and get creative. So the 2 types, differently from Uniswap, the 2 types that of pools that are available on Balancer are private pools and shared pools. So let's start with shared pools. Shared pools are like Uniswaps. Anyone can provide liquidity, and they get shares, ERC20 shares of those pools, and they can withdraw at any time. And those pools are immutable. That means that whatever pool you add liquidity to, you're 100% sure that the weights are not going to change, new tokens are not going to be added, or the trading fee is not going to be changed. So it's really set for life. On the other hand, there's private pools, which are fully flexible. All the parameters can change, but only the creator, the owner of that pool, is able to add liquidity and remove liquidity. And the reason why it's possible, or for shared pools, it's not possible to change the pool parameters, is that the owner would be able to drain other people's money if they added like a token that they control the full supply of, right? So those are the 2 types of pools that are on Balancer. And there is a very interesting thing that can be built actually with private pools that we have been working a lot on recently. And it's what we call a smart pool. So a smart pool is actually a private pool with the owner being another smart contract. So instead of Juan or Will owning a private pool and putting their money, it's a smart contract that's putting its money. And the nice thing is that that controller, let's call it the controller of the smart pool, it can be a gateway for external liquidity to be added to this private pool, which is flexible according to the rules of the controller. So a very simple and exciting example of how this can be useful. Imagine a search pricing pool. So we all know very well Black Thursday. There's times when there's a lot of demand for liquidity. People want to trade, they want to cover their vaults in order to avoid being liquidated. They're not really worried about a 0.5% fee or a 1% fee. All they want is to buy DAI at the price, at the current price, because they fear that in 2 hours the price might be half the price now. So people are less sensitive. In those moments, the smart pool, what it can do is the controller can update the trading fee of the private pool that it owns, and the private pool holds all the liquidity that people add to that smart pool, and then that pool becomes more profitable. So it generates more trading fees, and by doing that, it attracts more liquidity, and it's like and it becomes better for traders, because the more liquidity it has, the lower the slippage, right? So I like to compare that to Uber and taxis. Pools that we see today on Balancer and Uniswap. Uniswap is always 0.3. Balancer can be any number, but it's static for shared pools because it's immutable. But it's not adapting to the market conditions, right? So with a smart pool, you can have a controller that people who provide liquidity to that smart pool, they know they can read the rules, the code in the smart pool controller. They know that all it can do is change the trading fee based on volatility. It can't add a new token. It cannot change weights. It only can change the trading fees. Now, the nice thing is that the smart pools are flexible. So we have a template, like a factory, where anyone can choose which rights that smart pool can have. And this is very useful, for example, for other projects like PyDAO or like Realty. Like Realty, I don't know if you heard of Realty, but I think it's also interesting for MakerDAO because we're working with them with the final goal of eventually having real estate tokens or index fund Realty tokens being added as collateral for MakerDAO. And I think we all agree here, at least that's the feeling I have that the MakerDAO community is going, is let's scale MakerDAO by accepting more types of collateral, including real world assets, like things that are tokenized, right? So just to explain the idea of Realty, like they have many different properties that are tokenized, and people who own shares of the ERC20 tokens of those properties, they get daily rent. So the rent that's paid to the actual property is converted to DAI, and then people get the rent in DAI every day. Now, the nice thing about Balancer is that it allows Realty to have an index fund of all the properties that I have, right? So they put them all into a pool, and the pool token is a share of the index fund of all Realty properties. Now, the problem is if you want to add that pool token as collateral for MakerDAO, it cannot change every second week or every month, right? It has to be something like kind of perennial and not ephemeral, not temporary. It has to be the same canonical token for years. The nice thing of smart pools in that case then is that Realty can start that fund with 5 different properties, and then in the smart pool, it can have the right to add new tokens. So whenever they tokenize a new property, instead of creating another pool with this new property included, if you think of shared pools, they would, and that would change the pool token. So that would be the case where all, like the collateral would have to change every time. Instead, they can have a smart pool where they can add new tokens. So they can grow the index fund, adding new properties while keeping the same smart pool token, which is used as collateral on MakerDAO, constant, right? So if they have more than 8 properties, eventually they can replace properties by cities, and cities are actually other smart pools that have other properties from, I don't know, Florida or Miami, and then you can grow this tree of neighborhood cities and still keep the same ERC20 that's used as collateral for MakerDAO, which represents real estate properties. So yeah, that's kind of a very exciting thing that we're exploring at Balancer today with smart pools. But the nice thing about Balancer, in my opinion, is that it can package any combination of tokens. So even shared pools that have a fixed, let's say 80% Aave tokens and 20% ETH, that is a pool that can be that is tokenized with BPTs and can be used or could be used as collateral. And the nice thing is that by having a pool being used as collateral, you keep the underlying fluid and liquid. So having a BPT staked as or put as collateral in Maker doesn't prevent people from trading the tokens that are inside this pool back and forth. So it's going to be more and more used by projects instead of staking or staking or locking up the project token. They're actually going to lock up a Balancer pool token that has their project tokens and ETH. So actually you're staking the proof that you're providing liquidity between your token and ETH, right? So it's this kind of idea of instead of drying up the liquidity of your token by locking up collateral, which is just the token, you're locking up the BPT that has your token and ETH. So you kind of are proving that you're providing liquidity with your token. So that's all. I think that's a very brief overview of how I think Balancer can be useful for MakerDAO as collateral, and also the BPTs, which are like could be anything. So happy to answer any questions you guys might have.
I have one question, Fernando, that might be a little bit amateurish for the call, but I'll shoot it anyway. I was wondering how when I add liquidity to a pool, I get BPT tokens. So what's the way to know which liquidity pool those BPT tokens come from? I don't know if it's clear.
That's a great question. So there's no way we can name a pool like Uniswap could say this is the DAI USDC pool, because there can't be two pools with those two tokens, right? Balancer can have duplicate pools. Anyone can create the same pool in a number of times. So actually you need the address one. So whenever you have BPT tokens, those tokens are actually the ERC20s produced or minted by the pool that has the tokens that are being, where the liquidity is actually the BPT token address. So I don't know if it's clear, but you have to look at the address.
For each pool, you have a BPT token.
Exactly, yeah, with a different unique address.
So that's why when you say add on MetaMask BPT, you would need to specify the token from, well, the address from that pool.
Yes,
okay,
correct.
Makes sense. Does anyone else have any questions for Fernando?
Yeah, I'm kind of interested from an Oracle's perspective. How would you value, like theoretically, how would you value a BPT token? Is it just the underlying? And if it is, how do you kind of how do you make sure that the underlying isn't, the ratio isn't manipulable to kind of manipulate the price of a BPT token from an Oracle perspective?
Awesome question. So the answer is the price of a BPT token can be deduced or calculated from the prices of the underlying tokens. It's a simple mathematical formula. It's just like each price has the exponent of the weight. So if a pool had 100% of one token, it would be just that price of that token to one, which would be the same price as it doesn't exist because a pool has to have two or more tokens. But there is the risk of having a sandwich attack. So so you would have to have some kind of fallback option like Link or Chainlink or any other anti sandwich attack mechanisms. So I'm not sure how.
Is there a way to kind of normalize the ratio over time? So the way Uniswap kind of does this is they have this kind of price accumulator, right? So it basically, right, it adds like the ratio of the ratio of the reserves, right, over time. And so you can take 2 different points, right, and kind of calculate your own normalized kind of reserve ratio instead of relying on the ones from the contract. Can you do something similar with BPT tokens, or is there some kind of alternative?
No, so right now we're going to do that for Balancer V2, but we don't have that accumulator for now. One option would be to use Uniswap as kind of a double check, right? A sanity check about the prices. So yeah, because Uniswap's oracles are kind of more resilient to gaming because of the accumulator, that is a very good option. Yeah.
Okay, thanks.
Thank you.
All right, so I had a question as well. Like I think I already know the answer. I just kind of want to confirm. With any like liquidity pool, the kind of value of the pool is like, so I guess the risk of the pool, I guess, is contingent on the risk of like the weakest token in the pool, because you always have this problem is if like the weakest token drops to like 0, then it floods the pool and the rest of the value is drained. Is that correct?
That is correct. That is correct, but there are some practical kind of limitations to that. So in order for a token to drain all the others, it would need infinite supply. It's the infinite supply attack. So it doesn't really suffice, or it's not enough for the price to go to 0. You really need to gather, like, concretely and in practical terms, you have to have this like a lot of supply of the token, and because of the fact that the supply is limited, then you can't really drain the other tokens very often. And also usually if there's not an infinite supply attack, prices can drop a lot, but they do not go to 0. And when you have a token that you're not really kind of comfortable with, or you think it's risky, you usually use a low weight for that token. So if you have a very low weight, even if the price drops by 100x, for example, the price of the impact of that drop in the whole pool will be the drop of that token to the power of the weight. So I don't have my calculator here, but if you do if you have a token of 2% weight and it drops by 10 times, 10x, you're probably gonna lose I don't know, 5 to 10% only of the value. So by limiting the weight of the tokens that you think could go down a lot, you can pretty much curb the possible loss if that token goes down.
Thanks. And, that's helpful. I didn't realize how the weight affected that. So that's useful. Thanks.
Yeah. You're welcome.
I had another one as well, but I'll let someone else go if there's any other questions.
Yeah, I have one. So hi, Fernando. Thanks for the presentation. So in case MakerDAO considers to onboard liquidity tokens, so BPTs, the idea there is that essentially MakerDAO boosts yields of liquidity providers, right? The basically farmers, however you want to call them. So the idea is that we would be obviously charging stability fee that is a percentage of liquidity mining rewards, but I know that those rewards are a function of balancer price, but also of the distribution, right? So I'm really curious, how does the whole distribution, the mining incentive scheme, how does it work? How frequently does it change? What's the actual framework there? Is it community-based? I guess it is, but yeah, just curious about it.
Yeah, great question. So we're trying to not change too often how the rules apply to liquidity mining. There's been quite some time that no new factors have been added. So we reached a stage where we're quite comfortable with the system not being gameable. So it is though the decision by the government. So if people decide that there's some attacks or some types of gaming happening, that are kind of being detrimental or not so beneficial to the protocol, governance can change the way the distribution of BAL tokens every week happens. It's a fixed amount every week, so it's a zero-sum game. So if people somehow try to game or manage the game and get a lot of BAL, it means that others will get less BAL. So it's that challenge of making sure that the distribution is as fair as possible, and that fair is then subjective, right? And that's why there's so many factors that we apply for liquidity mining to calculate who gets what. But it's interesting to note that if BPTs are used as collateral with MakerDAO, then MakerDAO would be getting those BPTs, right? And then there's like maybe another way for MakerDAO itself to be kind of earning more fees from those fees from those BAL tokens that are paid as liquidity mining every week. So I don't know how you guys think of dealing with that. The kind of the obvious solution would be to just send all the BAL tokens that are that vault gets, because it holds BPT, send it to the owner of the vault. That would be the easiest way, in my opinion. But you guys can charge, as you said. I'm not sure if you mentioned that, but if you meant that, but MakerDAO itself could charge a portion of the BAL tokens that the vault gets, and keep that as a protocol revenue or fee. It's an idea.
Yeah, that's basically an idea. It's, you know, it's though hard to, I'm not sure if it's possible to codify the fee based on the yield itself. So essentially, we're probably going to need to be a bit more conservative. And as I said, from that perspective, it's really important to know how low can the yields fall, so we're not, you know, having too high stability fee, because you would have an immediate unwinding of those vaults, which would be actually bad for DAI itself. I mean, for the price and for the liquidity and slippage. Therefore, you know, it's really good to have some estimates where the yields would be, considering balancer token can drop. But actually, yeah, my question was, if you consider BAL ETH liquidity pool, is it possible that, you know, governance could just the next day decide so that this pool doesn't get any rewards anymore?
It's possible, but that would be a really very dumb decision, because probably we would get delisted as collateral, and then the protocol as a whole would suffer. The balancer protocol would suffer. So I think the BAL token holders and governance has been very rational so far. So there is the risk. So the governance could like decide to do anything, but I think, yeah, governance is rational. So I wouldn't see that happening at all.
Okay, thank you.
You're welcome.
Any other questions? I think Akash said that he had a couple.
Yeah. Akash, are you still there?
Maybe your microphone doesn't work, Akash.
I have one more as well, but we can maybe skip it, seeing as we're at past.
Mm-hmm.
You want me to go? Okay. So my other question was going to be like we're considering like onboarding BAL itself as well. So I guess I was going to kind of ask how value accrues to the BAL token. Like, I guess it's currently used for governance. Like, is it planned that a fee from the pools is going to go towards like buy and burn for BAL or something in the future?
Yeah, that's a great question, and it's really up to the BAL token owners, to governance, to decide whether this is going to happen or not. The assumption, in my opinion, that BAL has value relies somehow on that hypothesis that in the future there is some chance that this is going to be activated, just the way Uniswap has this today 1.16 going to the protocol. So I do believe that lots of people think there's value in the token because of that, though this is not in our power. So that would never be done for regulatory reasons, like Balancer Labs is not going to vote or propose anything like that. But governance, like token holders, can enact a protocol level fee that goes to the BAL token, or accrues value to the token. Yeah.
Cool. Thanks.
Great. Okay, so if there's no more pressing questions, I want to thank you again, Fernando, for coming on and answering all our questions.
My pleasure.
Again, let's keep the conversations going in the forum. I don't know if you're there, Fernando, but if you
I am,
aren't,
yeah. I just read
okay.
Will's report, risk analysis. That was really cool and complete. So thanks again, Will, for that. Appreciate it. Yeah, if you have any questions, you can ask there and tag me. I'll be there and
Sorry,
answer anything.
can I ask a quick couple of questions?
Yeah, sure. If it's okay.
With the balancer tokens, is there an easy way to get the weights of what the pool has?
With the balancer tokens,
with the balancer liquidity pool tokens, is there a way to go backwards and figure out what the weights are for the pool?
Yeah. There's a function for each pool that is get weights. Very easy. Yeah.
Okay. The only other concern I have is like with something illiquid, there's kind of this recursive thing, right? So if it's XYZ token with ETH, and then you create like balancer pool tokens, which then go into Maker, and then you mint DAI, you kind of lever up. The mark maker who's on the other side when liquidations happens will have no liquidity in terms of liquidating the underlying tokens, right? Like they would get these liquidity pool tokens, go back to balancer, pull off the underlying tokens, and there would be no place to sell it. So that's one concern.
Of course, the choice of which BPTs would be accepted as collateral is very important. So I would never recommend you guys to say, let's accept BPT and that's it. No, there has to be a whitelist saying like BPT with ETH and DAI. That's something that's great for MakerDAO because it is already partially collateral that we use, ETH. And ETH and DAI is something that, if you think of it, yeah, it's kind of helping add liquidity to DAI, which is one of the most important pieces of the MakerDAO ecosystem. So yeah, of course, no, it wouldn't be like just any BPT. It has to be decided based on the tokens that are underlying. And if you're talking about shared pools, those are immutable. So you're sure that there's never going to be like an XYZ token being added that could drain all the value. If that makes sense, Akash.
Yep, that makes sense. That's a good point, that it should be only shared pools.
Absolutely, yeah. Or smart pools that we really trust, like Realty, right? If we know there's like a team that's not anonymous and has been around for a long time. I mean, like all the reputation stuff.
Okay, sounds good. Thanks.
Thank you.
Thanks again, Fernando. And yeah, let's keep the conversation going in the forum.
Thanks a lot, Juan. Bye-bye.
Thanks for coming. Matt, are you ready?
Yeah, let's do it.
Awesome.
Let me see if I can get a presentation working here. Excellent. Okay. I have a lot to cover in a short period of time. So my goal here is to talk about tBTC, but because we've had a forum conversation going on since May, I'm really going to focus on what's changed since then. So briefly, I'll recap what tBTC is, what we're trying to achieve with the project, go over how our first launch went, talk a little bit about what we're doing for this second release, growth, community involvement, and what I hope we can do with Maker. So a reminder, tBTC is a Bitcoin sidechain on Ethereum. I don't use the sidechain language lightly. This is a project that is meant to bring Bitcoin to Ethereum, but it's built by Bitcoiners and for Bitcoiners. So you're not going to see any centralized custodians. I think the only real point of failure we actually have right now is a centralized MakerDAO Oracle for the ETH BTC price. But our focus here is really to build something that can allow not just Bitcoin for market makers, but actual Bitcoiners to feel confident in bringing their collateral to Ethereum and hopefully to Maker. So it's a pretty complex system, and I'm just going to call out right now, I think it's the biggest risk to the project. We have built something that, on the one hand, verifies SPV proofs for Bitcoin that's deposited into tBTC, which is a pretty gas-hungry process. It allows tBTC to be minted if and only if Bitcoin is presented. And then we have an economic second-level bonding process that ensures that the custodians for that Bitcoin return the Bitcoin and physically deliver when a particular holder of tBTC wants to get back to Bitcoin's L1. So honestly, that by itself is an hour-long conversation going over the system design. So I'm not going to delve too deeply. We have tons of docs. I'm going to make sure that everyone has links as well as an updated proposal after the call. But this is really, I think, probably the biggest takeaway. This is an image that was taken from Andrew Kang's cross-chain pegging dilemma. And the basic idea is that, we have these approaches that use single custodians on the far left, like MBTC and WBTC. We have folks in the middle, like pBTC and RenBTC, that have come up with some sort of like half decentralized approach. We have others like SBTC, which are really focused on bringing price exposure of Bitcoin to Ethereum, but not necessarily physical delivery. And then on the farthest right, you have tBTC, which is a huge amount of engineering to get that far right, and it's definitely more expensive to operate for it. But I think that it's something that hasn't really been done yet in the space. So we launched this thing, and I'm now referring to it as release candidate 0. The DApp had a nice alpha on it, but if you guys were paying attention, the first 2 days after our launch in May, the team found an issue with how we were handling Bitcoin script. So our first release had undergone a pretty significant audit from Consensus, and this change had been audited. But frankly, looking back, like, all bugs are obvious in hindsight, right? Very clear bug. We published a post-mortem on our blog, and I'll give you guys a link in the chat. I really recommend you read it, because I think that what we want to do as a project is provide the most assurance possible to Bitcoiners and to people who want to trust their money that they think is sort of like the hardest money possible. And so we can't take issues with user funds security lightly at all. So when I find Zoom does not make this easy while you're presenting the chat. If you guys get a minute and you're interested in checking out the post-mortem on the pause, I recommend it. But since then, what we've done is we've spent the last over a quarter on just digging in, making sure that the practices that allowed that bug to exist in the first place were removed. We got 2 additional audits, one from Trail of Bits, another from Sergey Delgado, who's a prominent Lightning researcher. We have an ongoing retainer now with Trail of Bits. I believe we have 16 engineer hours per month ongoing, and then we're also doing at least quarterly audits with them. We're also starting to bring formal verification into our process. So we have an audit coming up with Certora later this month. I think the real takeaway for us, part of it has been making sure that our process is better for this release, but the other part has been that tBTC is an immutable set of contracts. So unlike Maker, for example, that's a heavy, really it's governance. I think that's what you guys are shipping as Maker, is governance first. tBTC is meant to have as little governance as possible, and that means it's fragile. So we've really had to double down on as much assurance upfront as we can. So one of the changes that we've made with RC.1 in this recent release was moving to a guarded release. So far, we've been live for 4 weeks, and 750 BTC is allowed to be deposited and minted into tBTC at one time. That schedule continues to 9 weeks to a 3,000 BTC supply cap, and then it's lifted. So far, we have 380 tBTC that's been minted and kept in existence, but 1,800 that have gone through the system and minted and redeemed. I don't think that velocity is natural. It's being incentivized by the way that we are distributing Keep tokens, which I'll talk a little bit more about in a minute. We've also had pretty significant interest from ETH holders. 48,000 ETH right now is in the system and ready to back the tBTC bridge. 23,000 is currently locked and actually backing Bitcoin. So the TVL right now is 55 million, and that's Keep that's been locked, ETH, and BTC. This is the growth so far. Again, you're going to see a step function because this is a guarded release. I think people haven't run into the cap. They've sort of stopped shortly under it, and then we've seen it slowly going up with each increase. But it's definitely still early days. We're 4 weeks in. I'm pretty excited. I think that this is the one, and that we're going to make it the full 9 weeks. And then a little bit to kind of show the deposits and redeems. So obviously the current supply is an interesting number, especially interesting when you're looking at tBTC as collateral for something like Maker. But when you're actually looking at security of the system and whether or not it's working well, I think the most important thing is to see how much money has actually gone through the system. So far you can see that the deposits and redeems have been fairly matched. So people are definitely putting money through, taking it out, waiting a little while. Currently, there's not much to do with your tBTC once you're on Ethereum. We haven't yet launched liquidity rewards. We want to be very careful with incentivizing deposits in a new system. And our integrations with Curve and some of these other players in the space are going to be dropping shortly. So I think in a week to 2 weeks, you're going to start seeing the cap getting hit a little bit more aggressively. And then once we've hit 1,000 BTC, so a week from today, we plan to just very carefully roll out our incentives for minting and keep people from getting too far ahead of themselves. So here's the cumulative volume so far, just kind of driving that home, and then Keep stats as well. So funny thing, I'm pretty proud that our community has actually built all the tools that I've shown you so far for all of these stats. So if you guys are interested in tracking this, it's keepstats.org. But moving on a little bit, the community has grown incredibly. So far, we have 131 stakers on mainnet backing tBTC deposits and over 500 on Ropsten. Our goal is to hit 500 independent stakers by the end of the year. So what that means is those are people who hold Keep, which is the work token behind the system that keeps it permissioned right now, and who have put down ETH to basically provide assurance that they are safe custodians for your Bitcoin. And of course, that's up for seizure if they're dishonest. So far, the majority of stakers on mainnet are from the community. So I expected that our stakers would primarily be like big VCs and folks who have gotten involved with us in various private purchases. But actually, it turns out it takes them a long time to set up a staking operation. So right now, the majority of the bridge is run by the community. Employees are starting to come online right now. So folks who have been involved with the creation of tBTC. And then we'll see plenty of the larger holders of Keep also getting involved over the next 3 months or so. So the community engagement has been great. And then I just also want to talk about what we have done so far with liquidity. So instead of focusing on growth, obviously this guarded release has handcuffed us. And that was intentional. That was something that we chose to do to make sure that this release was safe. So what we've done instead is we've incentivized cover through Nexus Mutual. So right now there's $10 million of cover, which is quite a bit higher than the supply cap available for anyone who wants to mint tBTC and be confident that they have an actual treasury backing it in case there are any issues. We are going to be announcing one other similar protection first liquidity reward within the next, hopefully within the next couple of weeks with a separate team. And then shortly after, you guys will hear more about the DeFi rewards launching with Curve. We expect with Balancer, Uniswap, etc. To share a little bit more about liquidity rewards and growth, 5% of Keep's token supply has been set aside just for tBTC liquidity. So we do not plan on offering flash yield. We do not plan on going crazy and getting back to the 3 and 4 digit APYs that we saw over the past 2 months. Instead, we're going to be using Keep to incentivize people who are minting tBTC and then putting it to use. So not just folks who are holding, which is pretty boring. You're just making your Bitcoin less secure by adding another chain. But instead, folks who are, for example, putting their tBTC on pools like Curve. And what I'm really the most excited about is putting their tBTC into vaults and minting DAI. I think probably the biggest new thing, other than us having launched and obviously these security measures that we've taken for this call, is that we are actively working on a custom CDP manager that will allow basically direct incentives for anyone who holds a tBTC vault and mints DAI from it. And the reason that we're doing that is twofold. So for our project, I believe that that these WBTC vaults we've seen represent sticky users. So I think that there's an opportunity for us to start to bring people from centralized alternatives to decentralized and hold long-term, which I think is really healthy for tBTC. But the other piece I'm excited about is that I actually hope, and this is a little grand, but that I hope that our rewards can provide some additional pressure on the DAI price, because we'll effectively be subsidizing anyone who wants to finance via Maker. So the idea is that folks who are holding WBTC vaults, you would think that maybe they would like 2% return and negative rates for minting their DAI, and that we can convince folks like BlockFi and other centralized lenders to start bringing their Bitcoin to Maker and taking advantage of that opportunity. So that's it. I imagine there's a lot of questions. This is a lot of content, and we didn't really even cover the system design. So I'm going to be quick to post as many links as I can on chat. I've got everything ready to go here and ready to follow up on the forum once it gets hairy.
Thank you, Matt. Who wants to go first? Mm-hmm.
I'm not sure I have a question, but
Please.
I maybe just a comment on like the on like incentivizing DAI minting.
Yeah.
We've kind of talked about the same, like obviously we've been dealing with the PEC for a while, so we kind of talked about the same sort of thing with like Maker and other stuff. One of the reasons like I've personally thought it's a bad idea is that there's nothing really forcing someone to like sell the DAI, and it's actually like safer if they hold on to it.
Yeah. So let me be clear. What we would actually be incentivizing, and this is kind of a tricky smart contract to write, which is why I didn't come to the meeting with it, is for you to mint DAI and put it into an AMM. So
okay, cool. Yeah.
Yeah, it needs to be in the market. Otherwise, it's not helping with the price.
Yeah, for sure. Cool.
Yeah, can I get an idea of what is the business model of the company behind the tBTC? Because there are some kind of tokens, so you expect cash flows. But it seems that tBTC is not quite expensive.
Yes, yeah. So so the business model is very much get fat and happy on the tokens that we believe we're driving value accrual to. So the company is not an active participant in running tBTC. We do not actively stake or earn those rewards. Instead, we have a work token, and the value accrual for the work token is that if you want to earn fees running the tBTC bridge, you hold the work token. And as long as you are a good staker, your returns will be pro rata your holdings of the work token relative to everyone else that's staked at a given time. So if you guys are familiar with other work token models, it's kind of like a taxi medallion. You hold keep, you stake it, you can now do work for the network and earn on the Bitcoin bridge.
Do those fees come in like Bitcoin, or is it? I
They
guess it is
do.
Bitcoin.
Yeah,
cool.
yeah. So they do. Yeah. So we've started very low with just 5 bips in tBTC. So every time you mint, the fee for that is set aside, and upon successful redemption, it's given to those signers. There are a few governable components of the system. So I think we've got it down to 5 functions, but there's the pause of new deposits, there's setting the signing fees, and then there's also setting the lot sizes and the collateral ratios. All of those governable components are governable forward, so they don't impact existing deposits, only new deposits. Right now, the team has that power. We haven't announced our plans to give it away, but I have no interest in holding on to the liability of that for very long. We just want to hold it as long as we think is necessary for the network. So likely those governance abilities will also go to keep token holders.
Matt, I do have a question regarding the ETH. It seems that the tBTC is collateral twice, maybe like you would hold the BTC on the BTC multi-sig contract potentially, and on the other hand, you would also hold enough ETH so that if one of the contract fails, you have the backup from the ETH. Is that how it works?
That is, yeah. So this first design, and I don't talk about a V2 a lot, but I'll briefly allude to it, is defense in depth. So if you were to just hold the Bitcoin and then release tBTC, you would expect that it's possible that the custodian could walk with the BTC. So what this system allows is that you additionally hold ETH collateral, where not only will the custodian be punished if they walk, but users actually get full recourse. So you buy back tBTC and deliver it back to them, and they're not out any money if a custodian does refuse to physically settle. We've already had a demonstration of this once on mainnet, where a novice staker just like flipped off their machine and didn't have anything backed up. It was pretty incredible. It was a really good learning moment, I think, for everyone, and definitely for that staker. And yeah, so the nice thing is that the person who wanted their Bitcoin just made a call and they were able to take the collateral from that signer. So it's very, very heavily, the design is very, very heavily favoring users at the expense right now of signers. There are plans for a V2, but it would look very much like a SI to DAI migration, where the ecosystem has to decide if they want to move over. Really, the tBTC V1 is set to kind of live forever. So unless we find a 0-day, there aren't plans to like deprecate it. But yeah, it will focus on capital efficiency, because like, while that's great for security, it's also really expensive.
Right. Primoz, our risk domain facilitator, asked how long does BTC redemption process take? So I think he's referring to the keeper process, where we would need to auction the tBTC to recover.
So the process of just like getting back to Bitcoin on L1, it takes, I mean, depending on your trust of the Bitcoin network, it takes between 10 minutes and a couple hours for confirmations. A request and then you getting Bitcoin physically delivered within one conf is usually 10 to 15 minutes. So that's pretty fantastic if you need to make a run and get out of the bridge quickly. And then if you need to seize and kick off the auction, if you want to just take, so like if you think a particular deposit is well collateralized, you can kick off the auction and then just immediately take the auction yourself. It's a falling price auction. in which case, again, less than an hour to fully remove yourself and exit from the system. If instead you are trying to redeem from something that you believe is under collateralized, then obviously, there's a falling price auction that can go as long as 24 hours. So I think that what's nice is that if you're redeeming for physical Bitcoin, you can actually choose a particular deposit that you're redeeming from, and you can choose something that's high collateral. And then you would expect, when people hit 125%, they're up for liquidation anyway. So far we've seen a pretty flat ETH BTC collateral across the network.
So I think that kind of the focus of this question is keepers bid on tBTC on Maker, right? In the case of a Maker liquidation,
right.
The kind of important question is how long it takes those keepers to go from that tBTC back to DAI. So obviously there's like one path you can kind of, if there's liquidity on Ethereum with tBTC, you can kind of use that to go back to DAI. But if you have to go through this whole process, like how long does it take, like end to end sort of thing?
Yeah, so mostly, and obviously we haven't had a Black Thursday kind of event since tBTC's RC.1 launch, but mostly you're talking about 10 to 20 minutes to get back to physically delivered Bitcoin. Then of course, if you're trying to get the whole loop back to DAI onto a centralized exchange, you're going to expect another 6 confirmations for most exchanges. So then it's kind of a question of how close are you with your exchange and whether or not they'll give it to you more quickly. But yeah, so it's certainly not instant. We do have some work that's being done on quicker settlement to things like Lightning, but I expect that the ecosystem of Maker keepers is not quite ready to run Lightning nodes, so that might be less relevant right now. Does that help answer the question, Long? Sorry, this is you guys' domain less than it is mine, so let me know if I'm missing it.
Yeah, I think that covers it. It's more extension of Primish's thing, because I just wanted to kind of clarify, I guess, what the issue there was, or why he was asking that question, I guess.
Yeah, Akash mentioned CoinList. So we do expect that CoinList is going to have retail minting and redemption, and that'll be launching in 4 to 5 weeks.
Hey, Matt, are you guys looking to do any other bridges to other L1s or?
Yes.
Mm-hmm.
Yeah. So we're actually more focused on the sidechains first and the assets second. So right now on the docket, we've already announced Celo, which will be launching fairly shortly because they're EVM compatible. We're also in active discussion with Solana, Arbitrum. We have a lot in common with the Optimism team, but it's just like the L2 question is actually almost harder than the L1 question right now in terms of like where to go. So we're trying to balance obviously the engineering resources, but I do expect that we'll have at least 2 additional L1s launched through 2021. And then as far as additional pegged assets, I'm going to be honest, it's really low on my list. No one cares about BCH. And it's just not a secure thing to offer, period. So I'm just going to say up front, I don't think our team will ever launch a Bitcoin Cash peg. Some of the other pegs that you could imagine, so say something weird like Dash, they make it quite technically difficult to interoperate at like the level of security we'd like. I think the one other one though that we are aligned with would be Zcash. The reason is one that we worked with the ECC and Zcash teams to make sure that Ethereum has an EIP to support the level of interoperability necessary. And then the other is I have this dream of actually taking assets and moving them all to Zcash to get like a huge Anon set. And so like that's just very much like a longer term thing that we've been considering with the Zcash community. But like most of the other L1 assets that aren't already on Ethereum are not valuable right now if you look at volume. This is why people don't like me on Twitter, by the way, in case you're wondering.
So that's the reason.
Yeah, that's it. Well, I mean, everyone wants their asset to be the most relevant. And for the most part, I think we know on this call that they aren't. It's ERC20s, ETH, and Bitcoin.
good. Does anyone have any last question before we close? Okay. So thank you, Matt, again for coming. It was very informative. Again, as always, let's keep the conversations going in the forum. If you are in the forum, Matt. So if anyone want to reach out there, please do. Otherwise, you can follow him on Twitter. And yeah, thanks again to Fernando for presenting in the first half, and everyone else for participating here. Yeah, see you in the forums.
Thanks for having me, guys. See you in the forums.